Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can grab today on Amazon or by going to www.howtoretireontime.com. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to financial topics, we can cover it all. Now, that said, please remember this is just a show. It's not financial advice. If you want personalized financial advice, you can request your wealth analysis from my team today by going to www.yourwealthanalysis.com. With me in the studio today, Mr. David Franson. David, thanks for being here.
Yep. Happy to be here. Thank you.
Yeah, David's going to read your questions, and I am going to do my best to answer them. You can submit your questions at any time during the week by texting 913-363-1234. That number one more time, 913-363-1234, or you can email us at heymike@howtoretireontime.com. Let's begin.
Hey, Mike, what does a diversified portfolio look like?
So first off, don't think about one portfolio. Think about multiple portfolios. The traditional model in the financial services space is you fill out a questionnaire and here's what you get. Now I'm going to be a little facetious in saying this.
Okay.
So, based on your risk suitability portfolio, which you told us you want, even though you may not understand everything you put in there and the consequences of that, you've told us, so you can't hold us accountable. But now you're going to invest in large cap, mid cap, small cap markets. We've got some emerging markets. We've got these bond funds. We're blending it between corporate treasuries. We're putting in some high yield bonds, for a better yield, of course.
Yeah.
Most people I explain that to, they go, what in the world is any of that?
Yeah.
What's an emerging market? I mean, most people don't really know.
Yeah.
I mean, I guess now you can ask ChatGPT and say, hey, what are all these really fancy terms? And here's what it's going to say. Large cap stocks are just companies that have a lot of money in them. So think of like Facebook or Meta. Think about Netflix, okay? Their stock has a large market cap, which is where it gets this information from.
Yeah.
But it basically means there's a lot of money in that company. And then you've got your mid cap, small cap. It's just smaller sized companies.
Yeah.
The larger the company, the more stable it's expected to be. These smaller companies, they're expected to have more risk. Allegedly, there's more growth potential. But the reality is what's going on today is large cap companies just buy the small companies.
Oh, right.
And then just exploit their services, write off some losses, and then grow their own companies.
Yeah.
It's not like it used to be.
How did it used to be? What was the
You buy the
old
small
paradigm?
cap companies that you believed in, and then they had exponential growth. Look at Chipotle. That wasn't as large of a cap as you would expect. It wasn't as big of a company as you'd expect. But the growth, so Pershing, I think it was Pershing, what's his name? Bill Ackman? Is that his name? He's one of the hedge fund guys at
Sounds
Pershing.
familiar?
I believe, as the story says, they bought it. They kind of made some changes with the company. They got a new CEO. And it just took off. I mean, the company just exploded, did really, really good. So that's, again, if you buy a smaller company, there's more risk, more growth potential. That was the traditional idea. And you can get down to even micro cap stocks, smaller companies or nano companies. These are pennies, very risky. But if you got lucky, I mean, technically NVIDIA at some point was a small cap company. So anyway, emerging markets, you're looking at other countries. So it's a way to broadly diversify. Now, let me quote the great Charlie Munger, Warren Buffett's right hand. I love this quote.
All right.
He says, broad diversification is madness because when you buy a little bit of everything, you inherently have mediocre businesses in your portfolio, which will give you mediocre returns. Do you want mediocre returns?
Who raises their hand for that?
People do every day without knowing it. And that's by saying, well, I'm 60 years old, so I should have 60% of my assets in bond funds. Why? Because that's what you do.
All right. Yeah.
Why do you do it? If you just ask why, like how kids will ask why when they learn that question, and it's really annoying.
Yes.
You should do that to your financial advisor. Well, why is that?
Yes.
Well, why is that? How come? Can you explain why? Any research to back this up? You realize it's almost like this rule of thumb of just a general guidance of trying to help people handle the volatility based on their stage of life than actually doing what might be in their best interest. Here's why I argue that, okay? I'll give you two secrets.
Okay.
They're not really secrets, but it's fun to call them a secret.
Yeah.
Do you want to know how to beat the S&P every year?
I do. I want to know.
That's very engaging. Yeah, I do. All right. Don't actually do this.
Okay.
Please don't do this. I am oversimplifying how to construct a portfolio to prove a point.
Okay.
You buy S&P 500. Let's say you put 90% into SPY or VOO. Okay. Those are two ETFs, low cost. It's the S&P 500. That's the benchmark everyone likes to talk about.
Right.
Okay. Which is kind of funny. That's the benchmark. It's not the best benchmark. It's just a benchmark, but whatever. So you've got that benchmark. Okay. Now put 10% in, let's say, Apple.
Okay.
And that's it.
That's it. I've got 2 positions.
Yep.
All right.
Over a long-term period of time, whether it's most single years or a 2 or 3 or 4 year, you would probably beat the S&P almost consistently.
And what's the S&P do usually?
S&P 500, it's 500 stocks that Standard & Poor's has deemed to be credible and good.
Yes.
It's not the largest 500 stocks in America.
Okay.
It's just whatever S&P has deemed to be a good company. And I say that kind of sarcastically because I have no idea how they actually quantify that. I think they pick good companies to be in there. I just like a little bit more transparency on that. But it's not the 500 largest companies. It's just 500 large companies.
And this is Standard and Poor, and they're like some organization.
They're a rating company.
Okay, yeah.
Yeah. Good company. I like the company.
Yeah.
I'm not disparaging the company by any means.
Sure.
I like what the S&P does and their research. So they have 500 companies. Do you think all 500 of those companies are doing a great job at growth? No.
No, probably not. That's a lot.
So if you just take one company, usually in tech, that has a stable track record of growth, what you've done is you've taken the S&P and slightly overweighted it to a company that you believe has more growth potential, more consistent growth potential than the mass of all of these other companies. So the odds are now in your favor because you slightly weighted it, which you slightly increased your risk, but you've slightly also increased your growth potential. And you could, I don't know, find whatever financial tool online or just model this out. This wouldn't be hard to model out. I don't know what tools you can get for free online. We pay for our tools, but yeah, you'd probably beat the S&P in most years. So when people say, oh, well, you can't beat the S&P year over year consistently. Okay, well, that's not true. What are you being sold?
Yeah.
You have to ask the question. What does a diversified portfolio look like? Don't buy blindly a bunch of stuff. Diversify by objectives. Look, if there's risks you're concerned about, you buy life insurance in case of that risk. If you're not concerned about the risk, you don't buy life insurance. If you want growth, you go to equities or you go to stocks. If you want growth, but you want to kind of smooth out the ups and downs, you put some bond funds in there. You don't need to buy a bunch of everything. You need to understand what's your objective and what behavior or emotions are at stake here, because you need to live within your economic and your emotional limits. Some people can't handle the Wall Street roller coaster.
Yeah.
You want to be able to sleep well at night.
Yeah.
Now that is your bull market portfolio. That's the long-term growth, and stocks have more growth potential than anything else.
Yeah.
When it comes to investments. Now look, if you want to buy a business or if you want to start a business, you've got more growth potential there, but 85% of businesses fail in the first year. More risk.
Yeah.
If you want to do real estate, and there's this thing out there, they call it BRRRR or whatever, I don't know. It's where you buy a property that's kind of, it needs a little TLC. Okay. You then renovate it, then you refinance it, and then you take out the additional equity because it's now valued more. You take that and then you do it again and again and again.
Okay.
And you've got people like Robert Kiyosaki, the guy that wrote Rich Dad, Poor Dad. He talks about how real estate has made more money than anyone else. So what happens? All these podcasters, all these influencers talk about how they're brilliant real estate investors.
Yeah.
And the stuff they say is just insane. Here's my point. Why does Dave Ramsey hate debt? Because he did that, and then the markets turned and he got screwed. And he realized all of this stuff that people are saying, this buy and refinance, it's called leverage. And it means you're taking on additional risk. If you're okay with the risk, that's fine.
Yeah.
But you have to know what you're signing up for. And most people seem to not fully understand what they're signing up for. There's no way that you're going to cheat the market. There's no way you're going to cheat finance. There's no way you're going to cheat economics.
Yeah.
You are rewarded for the risk that you take. The problem is most people don't understand the risk that they're taking.
So they got to ask those questions. They got to keep asking why.
Yeah. Well, and then you get other stuff like, and I hate this, there's this tool out there where it's like, hey, would you be okay losing $200,000 in your portfolio? No. Oh, well, then you should buy an annuity.
Oh, right. Yeah. That's hook, line, and sinker, right?
It's like, well, hold on. Would you be okay if it dips 20%? That would be 200,000. But if you didn't need to touch the funds, and there's a high probability that it would recover within the next 5 years, but this is your overall growth trajectory, and you don't need these funds for 10 to 15 years.
Yeah.
Are you okay with the ups and downs knowing you don't need it for 10, 15 years?
Right.
Yeah, I could do that because I have these other funds on the side. I've diversified by purpose, by objectives. Then people can stomach it. But when you take something out of context,
yeah,
the diversified portfolio is just a bit of a sales pitch to sell either a portfolio in the market where they're going to charge you 1%, 2%, whatever the rate is, or you can do a robo investing. It's a diversified portfolio, same thing, except for you're not talking with a human. You're talking with a basic robot here. Or you can talk to someone that says, well, you're diversified, but man, that's a lot of risk. These are the problems.
Yeah.
So that's the bull market portfolio, long-term growth, knowing that you don't need to touch it for a long-term period of time because it can dip. You can ride out those dips.
Yeah. So any money you have like in securities in the market, yeah, I know that money is set aside. If it goes down, fine, because I don't need it for a while.
You can recover.
It'll recover.
Yep. Then you need your bear market
Almost
portfolio.
Yeah.
Bad news bears. That's how you remember bear markets are bad. Bull markets have the U, they're up. Okay. Bear market portfolio. Simple. It's your secondary portfolio. You put enough in there that you could have, let's say, 5 years of income. It's all protected. And there's really 7 or 8 different investments or products you can put in there. High yield savings, CDs, bonds, so treasuries or corporate bonds or any sort of bond instrument that you're comfortable with. You got fixed or fixed index annuities. If you're old enough, you've got cash value life insurance. If you also want to pay for the life insurance component, if you don't want the death benefit, don't buy it. And you've got buffered ETFs and structured notes. Some of those things you can buy on your own. Some of them you can't. They all have different offerings, different benefits and detriments. So blending some of them together might make sense. Understanding which products, I mean, just like CDs, you can buy a CD today, I think at like 3.5%, 4%, or you could buy a CD at, get this, 0.2%. Which would you prefer?
Sounds so good. 0.2.
Do your research. When you put together your stock portfolio, you understand what risk you're taking, or your real estate portfolio, or whatever, the alternative portfolio, whatever it is. Understand the risks you're taking, and then have your bear market portfolio and understand the risks you're taking. There's no such thing as a perfect investment product or strategy, but a diversified portfolio just means you've diversified your objectives. It's not, in my opinion, buying a little bit of everything, because perfect diversification means zero growth. You have to have risk for growth. If you have no risk, you have no growth.
That makes sense. Yeah. So you could take this sort of one single portfolio. I've bought a little bit of everything. And so, I'm diversified. Or we have these two different
portfolios, different objectives. And you can even have more portfolios based on different objectives. Maybe you've got a legacy portfolio that's specifically for the kids. Maybe you have an endowment portfolio. Maybe you have $20 million or you're selling your business and you put some funds into a charitable CRUT. So charitable remainder trust or charitable unit trust or annuity trust. Basically, they can give you some money, but it's going to go to a charity eventually. Avoid some taxes.
Right.
The point is diversify by your objectives, not this blind ambiguity of buy a little bit of everything because that's what you're quote unquote supposed to do. Don't fall into that trap. Get detailed, ask questions. Sound like Miss Frizzle from the Magic School Bus, if anyone even knows the reference. Was it take chances, make mistakes, get messy? Don't make mistakes with your finances, but get into the details. Explore your options, because just a 1% difference in performance in your portfolio makes a huge difference over your life. Huge. So don't just, kick it to the side and say it's good enough. That good enough could lead to significant money that's missed out as an opportunity. That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcast. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles, or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you, regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.